Hi, I'm Andrew Schwartz, Group Managing Director and co-founder of the Qualitas Group. Welcome to the Qualitas Real Estate Income Fund March quarterly presentation. I'm joined today by Nick Bullick, Senior Director of Real Estate and Portfolio Manager of QRI. The theme of today's presentation is why QRI provides a good hedge against rising interest rates and inflation. First, let's begin with a brief overview of Qualitas as manager of QRI. Qualitas is one of Australia's largest alternative real estate investment managers with extensive industry experience, institutional grade governance and track record. Funds under management as at the 31st of March totalled $4.22 billion across private equity and private debt. Since inception, we've undertaken 219 total investments, and of this amount, 172 investments were specifically in private credit. Remaining 47 transactions are in the nature of equity investments. Our equity skill set brings a unique and beneficial lens to our due diligence as a lender, which is reflected in our track record of no loss of investor capital since inception 14 years ago. I would now like to address specific attributes of the fund. The fund has a target return of the RBA cash rate plus 5 to 6.5% per annum. QRI is currently operating within the target range. The month of March, QRI reported a last trailing month distribution return of 5.35% per annum, calculated on an average LTM NAV of $1.61. There has been no impairment or interest arrears since the IPO of this fund, and the current historical NAV is $1.60. The portfolio is conservatively geared at an LVR of 66%. Diversification has been achieved through 35 individual loans, which are predominantly first mortgages. We are currently experiencing a stronger pipeline, and the manager notes that it has $300 million of new loan mandates through the Qualitas network, which are anticipated to crystallise over the next few months. I would now like to comment on the various factors as to why now is the right time to consider an investment in QRI. The yield calculation of 5.35% per annum, as reported in March, is based on a LTM NAV of $1.61. The closing price of QRI as at the 12th of May was $1.48. Mathematically, it implies a yield of 5.8% calculated at the $1.48 closing unit price. Secondly, QRI carries no leverage, so any increase in interest rates, to the extent this occurs, then 100% of those increases flow through to our investors. Thirdly, we are experiencing an environment of widening credit risk margins. So not only do interest rates to borrowers increase due to cash rate increases, but the risk margin is anticipated to also increase, which in the ordinary course should lead to greater returns for our investors. As Nick will explain, the fully secured portfolio has an average loan-to-value ratio of 66%, with a maturity profile of 1.2 years, allowing for frequent revaluation of security and reassessment of returns. Moving to slide 6, I would now like to outline various areas of priority at this point of time. Firstly, our highest priority is to remain vigilant with respect to asset management and to approach to managing impairment risk. We treasure our track record of no impairments or interest arrears since the IPO and during COVID-19, and we want to ensure we maintain this track record. We have various risk mitigation strategies that we ensure, including sizable equity buffers between our loan and the value of the secured property, sponsor guarantees and interest reserves, active monitoring and management of loan and borrower. We do not adopt a set and forget mentality. We are known by our investors to prudently review, risk rate and manage in great detail our existing loans. Extensive loan obligations and covenants, regular revaluation of security. We remain disciplined in our approach to asset reviews. Ongoing asset reviews were undertaken and the results were no material changes to internal ratings, no impairment on any loan, and all requisite interest payments are on time. The short duration of our loan portfolio allows us the flexibility to reprice our loans, plus the opportunity to switch loans out that might be fixed in nature to variable rates to take advantage of any upward movements in interest rates. Secondly, noting 46% of all loans in the portfolio are variable rates means that increases in the RBA cash rate in the ordinary course can be immediately passed on to borrowers in favour of investors in the fund. Thirdly, as risk premiums continue to increase, as observed in previous cycles, such increases can be passed on to borrowers at the end of the loan term, given the short duration of 1.2 years across the portfolio. Slide 7 shows the implications of a unit price that falls below the true NAV of the fund. It is a hypothetical set of numbers that demonstrates mathematically what level of impairment it would take for the unit price to trade at the current level. Currently, on a cents per unit basis, QRI is holding 4 cents of cash for every $1.60 of NAV. This implies the current invested portfolio value is $1.56. Given cash cannot be impaired, a unit price of $1.48, as currently indicated by the market, mathematically implies a value of the invested portfolio of $1.44, or an 8% loss of capital across the portfolio. In order to achieve an impairment of this quantum, it would require a complete erosion of the 34% equity buffer on average held by our borrowers, plus another 8% fall in the underlying real estate property security, totaling a fall in property values of 42%. Per our last cycle of asset quality testing, QRI has no impairments and all interest payments are up to date. Whilst one can never forecast the future with 100% accuracy, a 42% write-down nationally across all property sectors seems to be a particularly harsh assumption in my personal view. I've previously mentioned that the Qualitas Group has circa $300 million of mandated transactions for senior debt. This should not be surprising when viewed against a record Australian CRE transaction volume of $19.6 billion in the December quarter of 2021. This represents a 5-year CAGR of 15% since December 2016. Much of this is driven by the residential sector, which is experiencing long-term supply shortage. This is evident from the table at the bottom of page 8, where national vacancy is running at a historical low of 1%, coupled with each of the major cities experiencing rental growth rates well in excess of inflation. We expect continued demand for real estate debt and greater recognition of the role that alternative lenders such as QRI plays in the market. I will hand over to Nick, who will provide greater details in respect of the portfolio.
Hi, I'm Nick Bullick, a Senior Director within the investment team and Portfolio Manager for QRI. The QRI portfolio remains comfortably within the investment mandate constraints. This has been achieved by having 94% of invested capital secured by senior loans. 96% of security properties in the portfolio are located in capital cities of Australia. The one loan that's not in a capital city, representing 4% of the portfolio, is located in Newcastle, New South Wales, and is a residual stock loan. The portfolio also remains compliant with manager targets, which is to have less than or equal to 40% pre-development land loans, less than or equal to 25% construction loans, and greater than or equal to 30% investment loans. The portfolio composition continues to remain very simple and is diversified with 35 individual loans to a total of 30 borrowers. We know every security property and borrower intimately to ensure the covenants of the loans are adhered to and any potential issues are predicted and dealt with in a timely manner. The portfolio has a stable weighted average loan value ratio of 66%, and as Andrew mentioned earlier, the portfolio has a weighted average loan maturity of 1.2 years, allowing the manager to reprice, revalue and restructure all loans that are due for renewal. The portfolio continues to be heavily weighted towards the residential sector, which, given the supply constraints and weighted average LVR of 66%, we're comfortable with this concentration at this point in time. Exposure to New South Wales increased during the quarter from 24% to 32% due to the successful closure of 2 new loans in the state. This also had the knock-on effect of reducing exposure in Victoria from 61% to 53%. On the next slide, we wanted to detail how sophisticated our risk platform is, which has enabled Qualitas to build such a strong track record of zero investor capital or interest loss since inception. Not only are the investment team and risk team completely independent of each other, but the investment committee is separate again, giving each transaction a fully robust risk assessment. A key differentiator between Qualitas and other managers is the strong focus on sponsor quality, which is determined by the deep relationships our investment team have in the market. The rigorous assessment and hands-on management process means only the highest quality sponsors have their loans approved. Every single loan goes through the same transaction screening process, from initial evaluation, detailed due diligence, formal investment committee meeting, to third-party loan documentation and settlement. Thank you for your time, and I'll now hand back to Andrew to wrap up.
By way of a wrap-up, I would like to make the following salient points regarding QRI. Firstly, the combination of rising interest rates, rising risk margins and short-term duration of the loan portfolio with 46% variable rate loans provides an immediate, ongoing and effective basis to achieve higher returns for QRI. QRI has a track record of delivering stable monthly returns and no loan impairments to date. The manager continues to see a dynamic commercial real estate debt market experiencing strong pipeline for its transactions. The utmost importance is we remain vigilant with our asset reviews, which we will continue to undertake on a regular basis. Overall, whilst I understand that the current period of interest rate and inflation recalibration can be unsettling for many investors, especially in times of systemic equity market risks, it does represent an exciting environment for credit funds as it provides an ability to reprice both base rates and risk margins. In the ordinary course, short-dated property loans are fertile assets to provide a rapid response, allowing investors to reap the benefit of this new set of dynamics. As managers of this portfolio, from a pricing perspective, the current dynamic provides more pricing growth relative to a highly liquid price compressing setting, which has dominated the market for the previous 10 years. Thank you for listening to the QRI quarterly report that brings an end to this presentation.